Hello, and welcome to today's webcast, Energy Tax Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, with that, I will turn it over to today's presenters to get us started. Pat?
Thanks, Laura, and welcome everyone. Thank you for joining today's webcast. We appreciate it, and it might be good afternoon to some of you folks, but my name is Pat Hanley. I'm a tax partner that sits in Denver. I'm the Denver office partner in charge and also the firm's energy industry group tax leader. I also have Phil Horwitz with me, who's a state and local tax director, sits in Denver, but he's part of our consulting group. And then Daniel Kemp, who sits in Dallas, but serves in our R&D consulting practice and works with a lot of other credits. I'll be talking about the post-election tax landscape from a federal income tax standpoint, but before I get into it, we'll start off with our first polling question, which is, which sector of the energy industry are you affiliated with or is most important to you? Exploration and production, oil field services, renewables, or D, none of the above?
All right, thanks, Pat. We'll give everyone a few moments to respond. And a reminder to participate, please click the button next to the answer you choose and hit Submit. All right, and we'll give everyone a few more moments. And here are the results.
All right, interesting. It's spread fairly evenly. Got a good mix. So good information. All right. Well, I guess today's presentation on my part will be talking about anticipated federal income tax legislation. But before I get into it, I just want to have a quick overview of the legislation process. As everyone I think knows, legislation originates in Congress, not the White House. That both candidates leading through the campaign process were promising a lot of things, but it actually, has to start and finish in the House and the Senate. And with the Republicans having a very narrow majority in both, there could be some things that we anticipate coming through and some surprises at the end. With the filibuster rule still in place and needing 60 votes in the Senate to pass legislation, that's likely not going to happen. So I think we're going to have to rely on a simple majority of at least 51 and have budget reconciliation, which is what happened back at the end of 2017 with the Tax Cuts and Jobs Act. And the budget reconciliation is a 10-year window that says you can't increase deficit spending by more than a certain number. And I think it's about 1.5 trillion. So through that, there's going to be some things that probably fly through and some things that'll be negotiated and maybe either revised or eliminated. Speaker Mike Johnson stated that he would like to use budget reconciliation in the first 100 days of 2025 to deal with the TCJA, which a lot of those provisions are set to expire at the end of 25. However, recently, as of Tuesday this week, the incoming Senate Majority Leader, John Thune, stated that he mentioned to his colleagues that likely they're going to be addressing some probably more pressing issues like immigration, border control, expanding fossil fuel production, and boosting defense spending. So there may be two rounds of bills through budget reconciliation, one early in the year and likely one towards the end of the year. We've kind of recently heard too that the TCJA part of this may be dealt with towards the end of the year, which that's not great for tax planners on what may happen, because some of those may get retroactive depending on kind of what falls through. Even within the Republicans, even though there's a narrow majority, there's kind of two buckets of folks. The first being deficit hawks that only want to look at spending, that are really looking at what needs to be cut, et cetera. And then there's the congressional members that look at growth only through tax cuts, and Trump being in this camp with tax cuts and tariffs, being able to promote and stimulate the economy without as much focus on the spending side, although it all has to be reconciled. So just wanted to kind of set that framework on the challenges that Congress may have in getting through some of those ideas that were promised during the campaign trail. The TCJA was enacted at the end of 17, and at the time, a lot of the provisions sunsetting at the end of 25 seemed like a long ways out. But as we get to the end of 24, that's next year. So just wanted to highlight some kind of key provisions within the TCJA that's relevant to this industry and some of the individual taxpayers as well. Section 199A, which is the qualified business income deduction of 20% that comes through K1s, typically pass-through entities, limited liability partnerships, LLCs, S-corps, and even Schedule C sole proprietorships. 199A was enacted to bring parity for kind of the net individual tax rate to get closer to the reduced corporate rate, going from 35% to 21%. It's been very attractive in this industry because a lot of investments are through K1s, and so it does come through, and it's a 20% deduction subject to various limitations, but that's sunsetting at the end of next year. Bonus depreciation, very attractive in a capital-intensive industry. It's been phasing down about 20% per year. 60% bonus in 24. 25 we'll see 40% bonus, 26 20%, and then in 27 all assets placed in service will be zero bonus and subject to the regular maker's rate. So that's winding down. That's set to sunset. The $10,000 state and local income tax cap, Phil will be talking about that a little later. The excess business loss limitation, which has caught a lot of individual taxpayers by surprise. That was enacted, originally set at a $500,000 limitation on losses related to trades or businesses in any one given year. And so where this caught a lot of our high net worth or high income taxpayers is a lot of K1s coming in with pretty significant losses through intangible drilling cost deductions, depletion, bonus depreciation. Well, that number could be significant, but it's limited to $500,000 per year indexed to inflation. It's a little larger now. But with some of our taxpayers that had very large portfolio income or net investment income in excess of $500,000, a tax liability shook out. And the difference in the loss between the $500,000 and what's actually coming through converts to NOL subject to carry forward. This was originally set to sunset at the end of 25, but through the Inflation Reduction Act, it got extended to 28. On the right side, there's some individual provisions that I think people are probably aware of. The estate and gift exemption potentially going down significantly from 27 married couple to 14, and then on the individual side, 13.6 down to 7. And then the individual income tax top marginal rate of currently 37, it would revert back to 39.6. And then all the lower rates and the lower brackets would revert back as well. And then standard deduction really increased through TCJA. And then also the certain itemized deduction like mortgage interest, the SALT cap, certain limitations were in effect as well. So a lot of taxpayers have been deducting through the standard deduction and not itemized deduction. But again, that's set to revert at the end of 25. Through the budget reconciliation back in 17, I think the SALT cap and some of these itemized deductions were put in place to offset some other cuts. Also, part of the TCJA, there were several provisions that were permanent that are not set to expire at the end of the year, one of which was the reduction of the corporate tax rate from 35% to 21%, NOL limitation subject to 80% of taxable income going forward, no longer having a carryback of 2 years, but an indefinite carry forward period. R&D expenses being capitalized and amortized, and Daniel will get into much more detail on that in his presentation. Like-kind exchanges, Section 1031, only applies now to real property. We don't see as many 1031s lately, but they're still happening. And without the equipment piece being deferred, there are things to look at, like how the valuation is allocated and so forth. And then Section 163J, interest limitation, that's been a significant issue, especially with our oil and gas clients, and really all of our energy clients that rely on debt financing to fund their capital budgets, et cetera, especially in a high interest rate environment that we're in. And that limitation, just as a refresher, is interest expense cannot be deducted in a given year that exceeds 30% of adjusted taxable income. The adjusted taxable income currently is using tax rules, but more on an EBIT type of system after the deduction for depletion, depreciation, and amortization. And so after you deduct the DD&A, typically, it's a lower number. So 30% of that lower number really significantly limits the ability to deduct interest in a given year. The amount that's not deductible does get carried forward in a future year. It's not lost, but it's subject to those same limitations in subsequent years. There was a bill earlier in 24 that got passed in the House, but got hung up in the Senate and never got enacted, that would have allowed the add back of DD&A in that adjusted taxable income calc to free up a lot more interest expense. Also in that bill was the proposal to expense R&D, which Daniel will talk about. Again, those were discussed. They were kind of anticipated throughout the year, but still not part of tax law. There was part of TCJA eliminated the regular corporate AMT that we saw. There's currently, as part of the IRA, a corporate AMT, but it's for very large corporations. It's a 15% minimum tax on kind of a 3-year average on adjusted financial statement income. And that's, I think $1 billion or more. So it doesn't hit many of our clients, but it's there. The permanent disallowance of entertainment expenses. And then, as I mentioned, the 461L, it's not necessarily permanent, but it did get pushed out to 2028. So these are some of the things to think about with the TCJA. Now, those are kind of where things stand now. We've been hearing a lot through the campaign. Trump talked a lot about overturning TCJA. There's been a lot of recent discussions on the timing of that, and then which pieces and parts may get either made permanent or extended in the new administration. Again, through budget reconciliation, potentially there may be some negotiations on which provisions may be just extended, revised, or made permanent, yet to be determined. But that is definitely on the agenda. Also being discussed is reducing the corporate tax rate from the current 21% to 20%, but also reducing it to 15% for domestic manufacturers. We've heard a lot about repealing certain IRA credit provisions. I know that was discussed kind of earlier on, but the more and more this gets really looked at, we're anticipating that a lot of the existing credits may stay. There's a lot of red states where there's Republican congressional members that have benefited from a lot of these credits. Some of the projects have been started. The capital has been committed. It's created some jobs. It's obviously a boom to those red states. And so with the narrow majority in the House and Senate, we're anticipating that not everybody is in agreement to just kind of overturning the IRA and the unspent dollars. And so there may be some pieces and parts that may get eliminated or revised. We've heard EV credits and the like, but we're kind of anticipating that some of those larger, carbon capture, carbon sequestration credits that have very, very large dollars behind it may stay. Bonus depreciation reverting back to 100%. This is a very significant issue with our oil and gas clients and our midstream clients and even renewables in the capital intensive business that we're in. This has been really anticipated all along that once the new administration comes in, this is going to be the first thing they look at is reverting it back to 100%. Also looking at the add back of DD&A in the adjusted taxable income calc for the interest limitation under 163J, and then R&D expenses deducting rather than capitalizing. These were the items that were in the bill that I mentioned that was passed through the House but got hung up in the Senate. The Senate couldn't agree on other provisions like child care credits and other things, so it just stalled. But even if the TCJA doesn't get addressed till later in 25, there's likely going to be two budget reconciliation bills in 25. The one earlier that may happen in the first 100 days may address things like bonus depreciation going to 100%, the add back of DD&A and the 163J calc, and then R&D, because those are more kind of bipartisan tax bills that I think a lot of people, a lot of Democrats and Republicans would agree that would stimulate the economy and benefit really all industries. But specifically in the energy industry, I think all three of these things have very favorable outcomes. The question that I have is, will it be retroactive? And if so, will it go back to 1/1/25, go back earlier? The problem with waiting on these items till later in the year is it puts a little bit of stress through planning throughout 25 on estimated payments and the like on the retroactive piece of this. So we'll wait and see, but I could see some of these items getting in the earlier bill and then dealing with the monster TCJA provisions towards the end of the year. As we heard, both candidates talked about some other ideas for tax benefits. I think Trump talked a lot about exempting tips from federal income tax, Social Security income, and then overtime pay. This attracted, I think, a lot of voters, both young, old, and was very, very attractive. And then also deducting auto loan interest. These are the items that I don't know will make it through because they may have some disagreement among the congressional members on, how are we going to offset these items? Because again, they've got to go through reconciliation and make sure that, everything follows the rules of the reconciliation piece. And so, once we get legislation, that's great. We'll all see it. We'll all read it, try to make some sense out of it. But what does that mean? And this is where I want to just highlight a few things that we're thinking about once these get enacted, if they do and when they do. But naturally, anytime you have a corporate rate reduction or any changes in individual rates or deductions, there always needs to be a review of the entity choice versus corporations versus flow-through entities like LLPs, LLCs, and the like. Typically you've got to model out what the net effective rate looks like from startup all the way through operations to the exit. And we did a lot of this work right after TCGA when the corporate rate went from 35 to 21. And what we've kind of found through our models, and our M&A group has some pretty sophisticated templates and modeling software packages that can do this pretty efficiently. But it really boiled down to, in the C Corp arena, when the corporations would distribute the earnings, because C Corps are subject to double tax, a corporate level tax, and then a dividend income tax once the earnings get distributed. If the corporations reinvest earnings back into its trader business, that single layer of tax at especially 15% is very attractive, versus looking at the individual tax rate less the Section 199A 20% deduction. You really got to compare the two, especially on the exit, when there could be some capital gain lower rates at the exit when it flows through to individuals. But you really can't answer that question in theory. You've got to really put the pen to paper and lay out what taxable income looks like based on a 5-year forecast, 10-year forecast, and then a potential exit strategy. And going from 21% down to 15% may make C Corps, pretty attractive to the extent that they're not distributing out all of their earnings every year through dividends. But even if they do, there's got to be some equilibrium. And there's other things to look at outside of rates. There's some flexibility with partnerships, especially with incentive units that we see a lot. A lot of our clients are private equity backed in the portfolio income structure, and incentive units or profits interests are still very attractive to the management team and the executives to potentially get capital gain rates at the end of the deal or through, significant operations along the way versus potential RSUs or stock options in the corp setting. So a little bit of apples to oranges in that setting, but that's where I think our modeling comes into play. Obviously, in the A&D world and the M&A, as I mentioned, you got to look at that as well when you're selling assets or selling stock, or buying assets or buying stock. When you're selling assets, obviously trying to strip out as much capital gain as possible. So looking at the Section 1060 purchase price allocation and looking at where the value lands within the asset buckets to maximize capital gain rates. And on the buy side, potentially allocating more value to tangible personal property, specifically if bonus depreciation goes to 100%. That immediate step up in basis and that immediate write-off is very attractive to buyers in an asset purchase. Now, in the 1060 allocation, both buyers and sellers have to agree to the allocation of purchase price. Now, they don't have to as long as they've got their own supportable allocation, but it's always good from a IRS kind of audit standpoint to say you agree. But again, looking at all these new potential tax changes when it comes to buying and selling assets and merging in the M&A world as well. Always something to look at. And then the last thing on this slide is just looking at, again, 163J, debt versus equity. I know the cost of capital is significant in our industry and looking at how much debt versus equity to take on. Typically in our private equity portfolio companies, there's both equity and debt, and that interest expense limitation can be significant the way it currently stands. But if you do get the add back of DB&A, it provides some alleviated pressure. But again, that's another item that we can model out as well, is looking at other elections and other things we can do to maximize the interest deduction while slowing down potentially other items, depending on kind of what forecasted taxable income and loss looks like. And so lots of planning to do once these potential changes become law. And then again, depending on whether they're retroactive or they're enacted on that date, becomes a big issue. I talked a lot of high-level issues today, which we don't have enough time to dive too deep into any one of these, but feel free to reach out to me. There'll be contact information at the end of the slide, and I know a lot of the people on this presentation, and so always reach out if you have any questions on any of the topics I discussed today. Happy to have that discussion with you. I will end it with another poll. I gave some of my kind of opinions throughout the discussion on what could happen, but will the Republicans be able to pass a concurrent budget resolution and utilize the budget reconciliation process in the first 100 days of the Trump administration? Absolutely, possibly, no, or D, I have no idea.
Thanks, Pat. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, we'll give everyone a few more moments to respond. And here are the results.
All right. Yeah, I think a few weeks ago, out of the absolutely would have been much higher, but based on what we're hearing in the last week, I could definitely see the absolutely going down and possibly going up. So uncertain, but we're all going to be watching it. Thank you. I'll pass it off to Phil.
Good morning, everyone, or good afternoon, depending on whether you're east or west of the Mississippi, or in Texas, I suppose. Before we jump into the details, to get 4 polling questions in, we're going to have 2 in a row. So here is another polling question. If we could move on to the next slide. So what will happen to the SALT deduction that Pat was talking about, the $10,000 limitation? No change. The $10,000 max will stay in place, state PTET as it is, the pass-through entity tax deduction, or the pass-through entity tax election. B, increase maybe to 25,000 to 100,000, somewhere in that range, depending on the balance of power between the high tax states and the low tax states, but still remain as a limit. The SALT cap disappears. So we go to pre-TCJA law, and you get an unlimited deduction for the state and local taxes. Or D, the state PTET election is disabled, so the SALT cap is enforced even against pass-through entities and participants in pass-through entities. So let's see what people think might happen to the SALT election, or the SALT cap and the state pass-through entity tax election, before we move on to our detailed discussion.
All right, great. Thanks, Phil. And also just a reminder, for those of you who would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts. We will also be sending the slides via email after the webcast. Also, feel free to submit any questions in the Q&A box located on your console. Take care of some business before passing on to the results.
Laura, we're getting a lot of Q&A notes that nothing seems to be working on the question. Can we try to reset that?
Yeah, let's give this another try. All right, let's see. That does still not seem to be working for everyone. Apologies. Let's move forward, and we'll try to come back to this at the end. That's all right with you?
Yeah. So let's move on. I will just comment on that last answer, and if I affect people's answers, so be it. That fourth option of the state PTET election being disabled at the federal level is an interesting possibility. We're seeing some internal foment as a possible way to pay for some of the tax or revenue negative things that the incoming administration is going to want to do. Obviously, Trump is going to be pro elimination of the SALT deduction limitation, but everything has to get paid for somehow, and so it is one of the chips on the table that is a potential change. So along those lines, let's move on to the first issue I wanted to talk about, which is that pass-through entity tax election. Because so many in the energy space are structured as pass-through entities, this does tend to be a pretty big issue. And there have been a few changes to the PTET landscape in the last year. In Hawaii, we've seen their PTET essentially get fixed. Hawaii started out with an imposition at the pass-through entity tax, at the pass-through entity level, of their highest corporate rate rather than the highest individual rate. That was fixed. And the other issue was that Hawaii was not allowing a carry forward of any unused credit, and that was also fixed. So now, even though it's not refundable, it is at least carry forwardable. So the Hawaii election becomes more favorable. Obviously, not a lot of oil and gas in Hawaii, but there is a lot of wind. The source of that wind I won't guess to, but anyway, a lot of wind in Hawaii. In New Mexico's PTET is now quite easy to make after 2023 amendments. Similarly, Colorado's election was amended, or was adjusted a little bit to make it easier to make. Oklahoma fixed their due date, or I don't know about fixed, but extended the due date to the extended due date of the return, which makes it much more attractive as well, or at least much easier to calculate and figure out whether or not you want to make that election and take it in Oklahoma. I will note that Pennsylvania and North Dakota are two major oil and gas states, and they are two of the very few states that have not enacted a PTET election. I think if the SALT cap survives as a limit and the PTET election is not disabled, we probably will see Pennsylvania, at least Pennsylvania, give it another shot and try to adopt that and get that through their legislature. The last item I think is that's worth noting is along those lines of that Oklahoma change. Do be aware of those election deadlines. In some states, you have either a payment deadline that has to be made early during the tax year, or sometimes June of the tax year. And if you don't make that election, if you don't hit a certain percentage of the total tax due, you can't make the election when it's time to make it, or the election itself may have to be permanently elected at a much earlier date than you expect during the tax year rather than after the end of the tax year. And of course, that makes the calculation of the benefit very difficult. So that's the PTET election. The next item on our list is California. So I will say that I originally titled this slide "California Hates Oil and Gas," but they made me change the title of the slide so it was less negative. California doesn't hate oil and gas, of course. It only hates fossil fuels in general, or not really, but there is that sense, and California certainly has done a couple of things that I think are worth looking at that are disfavorable to the oil and gas industry. First of all, as of 1/1/24, California disallows percentage depletion. You must use cost depletion instead. There are questions about what the cost depletion basis for wells already in are. And then they've also disallowed IDC expensing. And once again, they've left us with a host of questions because they disabled the federal section that allows IDC expensing. But what does that mean? Does that mean that you're left with amortization, or that you have to deplete it on the same timeline as cost depletion, or have to take it as at the same rate as cost depletion over the life of the well, or possibly the worst answer of all is that you don't get it at all. It's just not clear how that kind of, what effect of disabling IDC expensing has on the remainder of the code, because California law didn't put anything else in its place. It just said calculated under the IRC as if you can't take IDC expensing. And so not totally clear on what happens, but the likeliest answer is that, at least our view is that the likeliest answer is that you take it over the life of the well. So I think that's probably the most, the answer we expect. Now, I don't have a slide for this, but I will say some things have come up in the last couple of months in Texas. So I should have a slide immediately after this that would have said Texas loves oil and gas, parentheses, except when they don't, and that would have been appropriate. But there have been a couple of things that are happening in Texas, not specifically with respect to oil and gas, although there are some squirrely things in Texas. But one issue that has come up recently is that Texas is proposing a new regulation on data processing services. You may think that data processing is not an issue that affects you, but data processing, if you have operations in Texas, data processing is an issue that should be affecting you, and much of what you buy has the potential to fall under the umbrella of data processing in Texas. And of course, in Texas, data processing is taxable. So the new regulation would expand the definition of data processing significantly. It would also change the test that's applied as to whether or not the overall service, the product that you're buying, whether that is defined to be data processing or not. Texas traditionally has used the true object test or the object of the transaction test for all of the services that they evaluate in determining where it falls under the Texas code. Texas, in this new data processing rule, is proposing to switch lenses and no longer apply the object of the transaction test, and instead apply something called an ancillary services test, which is a much more restrictive test. And again, in addition to expanding the definition of what they think data processing is, it also expands the reach of that data processing rule into things that only have, what I guess they would say would be non-ancillary elements of data processing, even if the overall object of the transaction is something other than data processing. So that's a sea change in Texas that would make much greater proportion of the services that all energy companies buy subject to tax. Now, the thing to note about this is that all of this is being done through regulation. None of it is being done through the legislature. And so there's a big question about whether or not this is an appropriate rule, whether the rule can make the changes that it's proposing to make, and what the true statutory meaning of the statute that the reg operates under, what that statutory meaning is. The one thing before I move forward to the next slide, so we've got California and Texas, both huge states. One, a huge oil and gas state. California, not really a huge oil and gas state, but a significant renewable state. And as we saw at the beginning of the presentation, we do have about a third of our audience is in the renewable spaces. One of the things to note about California, especially if you're an oil and gas producer, is that you may think that we have no production in California. Why do we care? But these changes are a big deal if you're in a pass-through, flow-through structure, and you have California, even if you have absolutely no operations in California and no California apportionment, if you have California partners, California individual partners, those partners, the K-1s that are issued to them, will have to have all of their income calculated, or all of their tax attributes calculated with the California changes in mind. because that California K1 will have to show all of those federal numbers adjusted for these California changes. So these California changes are big, even if you have no California operations, because so much of the capital market is in California. All right, moving on to California renewable energy. If I can figure out how to move the slides. So there was a change in the renewable space in California as well. And some of that related to these active solar energy systems. And California law had previously treated any change of more than 50% control of any partnership as a trigger for reassessment, that is for property tax reassessment. And a lot of the functional ways these energy credits were triggered was through a partnership flip transaction. And that partnership flip transaction was interpreted by California to involve a more than 50% change and require reassessment, which was going to be a huge deal and a huge tax cost if you were subject to reassessment. However, California in 23, California adopted a change of the definition of change in control to allow these tax equity financing structures to not qualify as a 50% change in control. Now, there may be subsequent events that trigger that reassessment, but at least the partnership flip transaction itself will not trigger that reassessment. The other thing I wanted to note, as Pat talked about during his presentation, there is continuing talk that even if not all of the IRA is completely rolled back, there is still a significant chance that some of the more individual-friendly elements of the IRA might be repealed, and California has talked about stepping in and providing those in the renewable space, or specifically in the EV credit space, that those would be backstopped by California. And the other thing to note is really just I have it here on this California slide, but it's really a much broader issue, and that is, of course, that many of the changes that are in the IRA, that are in the TCJA, have downstream effects on your state returns, and many states deconformed to those changes, and so you'll have to watch that space as we see what the feds do. The states are going to have to make their own determination about whether they're going to conform or not. And then, as I mentioned, ITCs and PTCs also do have downstream effects on your property tax base, which is an interesting carry forward or carry over. And so, any changes to the IRA that change those tax attributes may also have state tax effects that we're not really thinking about as we're evaluating what the feds are doing at that level. So it's worth taking a close look. All right, of course, I'm running quickly out of time, so I'm going to run through these last three slides pretty quickly. But these are all things to really be alert for, and to recognize areas where many energy companies are overpaying tax. In the oil and gas space, we find that many oil and gas companies are overpaying their severance tax significantly because they're not fully recognizing all of the expenses that they can take in calculating netback price for the severance tax. And so when you're going through your netback calculation, what we find when we go in to look at the severance tax and really scrub it on new clients is that they're not taking full advantage of all of the expenses that they could be, and that's worth taking a close look at, because the refunds that we're finding from many of these oil and gas companies are large, and they make a huge difference to the bottom line. And so it is worth scrubbing those expenses carefully and looking carefully at your severance tax, making sure you're calculating it properly and taking all of the expenses that you can. In the sales and use tax arena, again, this is just an issue of many taxpayers are overpaying, and it's often the case of not realizing what exemptions you're eligible for. Sometimes these are hidden in the manufacturing exemption, depending on the state. Other exemptions may be tied to workovers and new production. So when you first bring a well on, or when you work a well over, that may trigger a new opportunity to get tax exemptions for the property that you're buying and the sales tax on that property. In Texas, chemical purchases may be exempt depending on use. And then as I talked about, the changes that are happening in Texas are worth taking a close look at. Texas is very aggressive. That was the other kind of except when they're not piece of my Texas comment. Although Texas law tends to be relatively favorable in the fossil fuel space, the application of that law by the Texas Comptroller's Office is often non-favorable. The Comptroller's Office is very aggressive on audit when it comes to oil and gas operators. This is true just generally. The Texas Comptroller's Office is very aggressive on audit. And then the other thing that you may not be kind of entirely cognizant of is that your vendors are being audited by Texas, and the Texas auditors are being very aggressive, particularly like, for example, in the data processing space, where Texas asserts that a service is data processing, and they force your vendors to start collecting tax. That may well be an error, and you should carefully take a look at those vendors that you're paying a lot of sales and use tax to make sure that you agree that those services really are taxable in Texas. It's often the case, we've seen it a lot, that those vendors are being forced to charge tax because of the aggressive nature of the Comptroller's Office. And in fact, you have a pretty decent refund argument that you should not have been charged tax on those transactions to begin with. So in every state, it's a little bit different, but sales and use tax is another place where energy companies are paying a lot of sales and use tax, and it's not clear that they always should be. And then the last item I just wanted to touch on very quickly is property tax. And again, this is just an issue of a lot of energy companies overpay property tax, either because the property tax base was set too high when they acquired the assets from often the previous operator. Obviously, if you've purchased it new, that's not an issue. But if you've purchased used equipment, the property tax administrator, whether that's centrally assessed or at the county level, often have significantly too high a basis. And then again, it's the same netback issue. Many operators are not taking full advantage of all the deductions that are available to them, and they really should be when they look at property tax. All right, so Laura, if we can redo that question once more, make sure everybody gets their CPE.
Everyone another shot, and we recommend, if you are having issues, to press F5. That should refresh your screen, and that seemed to work for a few people. So we will try this again, and if not, then we'll send out a communication at the end.
While we wait for that, one question came in that was asking whether, when I'm talking about these data processing changes, whether I was talking about sales tax. And I should have made that clear that, yes, I was talking about the sales tax rule on data processing services, and whether what data processing services or events are subject to sales tax. If I didn't make that clear, I should have. So apologies for that.
All right, well, it looks like a few people are still having issues, so we'll just kind of keep on going here, and we'll keep everyone updated about the CPE at the end.
Awesome. Well, thank you everyone for joining this afternoon. My name is Daniel Kemp. I'm a senior manager in our R&D tax credit group. I sit in our Dallas office, like Pat mentioned. I've worked in the R&D tax credit space for going on 10 years now, and I've been with Moss Adams for going on 8 years. Before I get into my spiel, let's see if my polling question will work. And pretty much it says, does your business have R&D expenses? Yes, no, or I'm not exactly sure what R&D is. Let's see if this one works.
All right. And if it does not, then we will let our learning and development team know. So
this one looks like it's working. You
no
see the
need to
counter
panic.
up.
All right, perfect.
For those that are in the chat, if you have an issue, if you don't mind letting us know so we can kind of see who had issues and who didn't, would be helpful. But it looks like this one's working.
We'll be able to submit that to our CPE team. So apologies for the inconvenience, but we'll pass over to the results of this one now.
Awesome. So even split. That's good to know for those that are unsure. Hopefully the next few minutes will be helpful as far as understanding how the R&D tax credit can apply to the oil and gas industry. So the 4-part test is the qualification criteria for an R&D project. And for the purposes of this discussion, I'm just going to use a new well as our R&D project. And the first part of this test has to be the business component or qualified purpose test. And there's a couple of pieces to this. You have to have a new product, process, software, technique, formula, or invention. So our product is going to be the well. And that purpose has to be for new or improved function, performance, reliability, or quality. So we have to have a new well, and it has to, again, we're in this business to make money, so probably have better function, better performance than other existing wells, or if we're just in a new field and we're trying to get the most out of a new field. The next is you have to have elimination of uncertainty, and that's pretty much, can we do this? We have a new field. We want to put a new well into that field. How are we going to do that? And I go back to 3rd grade science class. We make our hypothesis. How are we going to do this? And then what's the process that we're going to undertake in order to try to do this? And that leads us into our process of experimentation. It's the step-by-step process of how are we going to design our well? How are we going to drill our well, complete our well, and then ultimately produce our well? What are those steps within that process? And then finally, everything has to be technological in nature and seeking technological information. And what that means is the disciplines used have to be mechanical engineering, petroleum engineering, electrical engineering, things of that nature. It can't be market research or other kind of sales type functions. They have to be a technical discipline. What are the expenses that can qualify? And so there's 4 different cost buckets that we look at. Wages are the wages paid to your employees. It's the amount of time spent on R&D project or projects throughout the year for an employee on an employee by employee basis. Those get aggregated together and then put into our credit bucket. Next is supplies, and supplies could be a lot of different things. If we have some sort of pilot well that we're trying to design and then implement that into a broader scale, we could potentially take drilling fluids, frac fluids, materials that go into actually constructing the well. Computer leasing is more for a software development company, but for computer leasing, that's when software companies lease server space either through Amazon or Microsoft, and that's where they use it as a development space. And then finally, contract research is third-party vendors who are either helping with design or the actual construction piece of it, if the construction piece is more of a technical activity versus just we have a design, we give it to the construction company, and the construction company completes their purpose. The third-party design function needs to be what more or less an employee is doing, but they're just a 1099 individual. A quick note on state credits. So this is a list of what states offer credits. 2 of the bigger ones are Texas and California, which we've talked about in pretty good detail. The Texas credit offsets up to half of your franchise tax year over year, and then California has a pretty generous income tax credit. But if you have R&D from a Fed level and you're in one of these states, some of these credits can actually be better than the federal credit. And so if you're paying state tax, be sure you're looking into state opportunities as well as federal. So some industry activity examples. I've touched on the upstream piece already, but just a few examples in the upstream space: new drilling process, new completion designs, whether that be you're trying new fluids, you're trying new technology, you're moving into a new field that your company hasn't worked on before, and you're really just getting into the space. All of these different things could be potential activities for the R&D credit. And we've seen a lot of credits taken on new well spacing. It was even something that the IRS agreed on, was that well spacing was a qualified R&D project within the upstream space. Midstream, this is more of in the design of systems space. And some examples you have the construction of facilities and pipelines. Individuals that don't understand the oil and gas industry just think a pipeline and a facility appears out of nowhere. There's a lot of engineering involved. There's a lot of technical design reviews, whether that be environmental, mechanical, things of that nature. I've worked with a lot of clients that construct facilities and pipelines. You have metering systems, cathodic protection, things of that nature. If you're in the midstream space, there's a lot of opportunity for the R&D credit. Downstream, similar to midstream, a lot of construction and design when it comes to processing facilities. I did work with one client where they were not in the oil and gas space specifically, but they developed fluids and coatings for the oil and gas industry. And they spent, I don't know how many tens of millions of dollars on this pilot plant in order to develop a single barrel of these coatings. But in the downstream space, there's a lot of opportunity similar to midstream. Services, this is more or less the construction of different tools, compressors, auxiliary equipment, things of that nature that help support the oil and gas space. I've worked with a lot of compressor clients and a lot of tool manufacturing designers. That's a lot of your traditional R&D, where you're actually taking an idea, putting it on paper, making prototypes, testing those prototypes in the field before actually finishing up those, and then offering them to different operators and individuals that are actually going to use them in the field. And moving into some of our renewable space, tons of opportunity, especially in Texas in the solar space, designing of fields, designing of the technology surrounding what actually goes into these solar fields. You have the batteries, you have the solar panels, you have all the other ancillary technology that's needed in order for these solar panels to actually work correctly. A lot of opportunity moving into the renewable space, especially solar space here in Texas. Seems like every other day I see a new solar field popping up on the side of the highway. And some other opportunities too. Seeing opportunities in the wind space, as well as the different facilities needed to extract more or less the electrical energy that's being developed from wind farms and solar fields. Similar to oil and gas, there's a lot of facilities needed in order to transfer it to actually be usable. So something that's back, it's not something new, but it's something that's back and is now available again, is the marginal well credit. I'm going to read just straight from the slide here. It's taxpayers who have an operating interest in marginal wells are eligible for a non-refundable credit. Here at Moss Adams, we have a template that we can either provide you in order to do the calculation yourself, and we can review it, or we can do the calculation for you. But really the main point of this slide is to know that the marginal well credit is back for 2024. And it's a good opportunity for individuals who have some of the lower producing wells in their portfolio. It's a good opportunity to bring some money back in-house from lower producing wells. Just a little bit more information about the credit itself. So the max credit is 77 cents per MCF for 2024 with a reference price of $2.04. And then just a couple other opportunities that we're seeing from the IRA that are their own credits, but they also have R&D baked into it. You have 45V, 45Q, and 45X that are all more or less kind of in the renewable space, but these are opportunities for the energy sector should you be either investing that in your own business, or if you have other companies that are, this is what they're focused on moving into 2025. And these are all credits that here at Moss Adams, we have a team or teams that can help calculate these, document these, and get these taken care of for you. And we've touched on this briefly, and I know I'm at my time, so I'm going to go through this quickly. 174 capitalization requires you to capitalize R&D expenses over a 5-year period. You can no longer expense them fully in the year in which they are incurred. We're hopeful that this either is changed going forward with the new administration, or there possibly even a retroactive change. Like Pat mentioned before, we're not exactly sure the priority list of things going forward. And so we're hoping in 2025, there is something that occurs quickly in the year rather than later, just so for tax planning, we're not having to scramble at deadlines to either change something or fix something because the lawmakers were dragging their feet. So this is just a quick visual example of what needs to be included in 174 versus 41. 174, the way I like to look at it, is just the big brother of 41. You have your Section 41 costs, which is what I mentioned before, your wages, your supplies, contractors, etc. But for 174, you have a lot of other costs that you have to look at. You have depreciation, you have patent expenses, you have any foreign R&D must be included, utilities used to the extent of R&D. It's much broader. And so with 174, you can no longer fully expense these items. You have to amortize them and add them back to your taxable income. Questions? So I did see one question come in about R&D expenses being available to non-operator working interest owners. I don't believe so, Brian, but would like to discuss that more in detail if you'd like to set up a discussion.
All right, since we're at time, I think we can go ahead and close out. Apologies, everyone, for the issue with the third poll. We will have the CPE team view the reports and make adjustments where necessary. But thank you, everyone, for attending today. And thank you, Pat, Phil, and Daniel, for a great presentation. If we didn't have time to answer your questions, we'll do our best to follow up after the webcast. Feel free to reach out to any of our presenters. We also invite you to visit our website for more resources, events, and information, many of which are linked in your handouts window. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download, and as I mentioned, we'll have our CPE team look into that third polling question. And finally, here's a link to a survey for today's presentation. Your feedback is always appreciated. Thank you for joining us, and take care, everyone.